Thank you, Raymond, and I would like to welcome the management of BHEL on the call and thank them for giving us this opportunity. From the management, we have Dr. Nalin Singhal, CMD BHEL, Mr. Subodh Gupta, Director Finance, Mr. S. Balakrishnan, Director Industrial Systems and Products, Mr. Manoj Verma, Director Power, Mr. Kamlesh Das, Director Engineering Research and Development, and Mr. Anil Kapoor, Director HR. Sir, I would request you to give us opening remarks, post which we will open the floor for a question and answer session. Over to you.
Thank you, Kunal. Good evening, everyone. Very warm welcome to all of you. We continue to pass through a very challenging and difficult time due to COVID-19. I hope you and your families are safe and healthy in these difficult times. We are all aware of the impact of the COVID-19 on business environment during this period. The complete lockdown during the month of April and part of May, and partial lockdown thereafter has affected most business operations. Further, the migration of labor has also affected the operations at project sites. The impact on the overall economy is visible in India's GDP falling by 23.9% in April-June quarter, putting severe stress on finances of government and private sector alike. The industry-wide phenomena is also reflected in the fact that the average IIP for capital goods sector in Q1 2021 is lower by 64% compared to the similar period in last year. Amidst this, we have been facing further difficulty in collections as well as conversion of live tenders into orders. Even though uncertainty has now become the new normal, the economy is now gradually coming back to pre-COVID levels. The government has been introducing multiple measures to support an early revival. Capacity utilization levels in various industries like oil and gas and steel are already at par with pre-COVID levels. Cement and power are catching up. In power specifically, we are seeing a U-shaped recovery from the negative of 25% in early April to positive levels now. Daily freight traffic of railways is also showing gradual year-on-year improvement. Clearly, things are starting to improve. The policy support from government for Atmanirbhar Bharat is very encouraging. We are already seeing a lot of interest among Indian manufacturers for localization of critical components, which can become a significant opportunity for us going forward. The ongoing pandemic has delayed the capex cycle in the Indian industry. However, the Atmanirbhar Bharat initiative, coupled with the economic recovery, will help revive the capex. Coming to events specific to BHEL, we are using these times to improve our systems and efficiencies. Efforts are on to optimize costs and capability building through in-house R&D and tie-ups with various global OEMs for latest technologies. The expression of interest which was floated by BHEL, inviting global OEMs to leverage on BHEL facilities and capabilities for setting up manufacturing base in India, has received an excellent response. Under this EOI, BHEL has already signed 3 MOUs with international majors in the fields of maglev train projects, marine gas turbines for defense applications, and armored trucks equipped with smart technologies. Further discussions are on with several companies, and these are expected to see significant traction in coming months. Additionally, second stage EOIs have also been floated for technologies such as metro propulsion systems, railway signaling, track machines for railways, as well as air defense guns, for collaborating for specific technologies and increase in BHEL's range and competitiveness in upcoming tenders. Major global OEMs have participated in these EOIs and senior teams are working to close them quickly. Under the Atmanirbhar Bharat initiative, BHEL has taken a 3-pronged approach for maximum utilization of current opportunities and ensuring significant contribution to the national objective. These are in-house development and manufacture of items currently being bought out or imported by the company, in-house development and manufacture of major items in the country's engineering imports basket, working with global OEMs for manufacturing items for India as well as for exports, that is, make in India, make for the world. For this, the company has formed a new business group, the Make in India Business Development Group. The BHEL has also organized a workshop under the aegis of Department of Heavy Industries for promoting collaborations between PSUs, private sectors, private industry, as well as R&D institutions and academia for development and manufacture of critical items for helping manufacturers to disentangle their supply chains from imports. In follow-up to this workshop, BHEL is already engaged with interested parties and industry associations for taking this forward. All these activities are also expected to boost the capacity utilization of the company in times to come. Order booking has been hugely impacted due to a tendency to postpone investment during COVID-19 due to the COVID-19 related demand contraction. Up to Q1FY21, we booked orders worth 1485 crores, out of which power segment is 982 crores and industry segment is 444 crores, and remaining from exports. Major orders received in power segment include FGD package for 2 into 500 megawatt NTPC Tuticorin. In industry segment, major orders received during this quarter are supply of standalone turbines for 40 megawatt for SMP Power Generation Limited, supply of GT-driven natural gas compressor for GAIL Gandhar, supply of steam turbine-driven recycled gas compressor and motor with VFD-driven wet gas compressor for HRRL Refinery, Barmer, Rajasthan, and design and development of pump module for liquid cooling system of LCA Mark II for DRDO Aeronautical Development Agency. The total order book as on 30th June 2020 stood at 1,08,126 crores, out of which power sector is 86,603 crores, industry sector is 13,447 crores, and rupees 8,076 crores is from international operations. In addition to this, we are favorably placed in the 2 into 660 megawatt NTPC Talcher main plant package, fleet mode procurement of 12 number steam generators and reactor headers for 700 MWE PHWR reactors by NPCIL, and a number of orders for FGD and boiler modifications. Tendering is underway for 2 into 800 megawatt NTPC Singrauli, 2 into 800 megawatt NTPC Lara, and 2 into 660 megawatt Pench thermal power plant. Tenders for FGD for around 30 gigawatt are in various stages of ordering. Coming to the financial performance, turnover for first quarter 2021 is rupees 1,897 crores against rupees 4,410 crores during first quarter of 1920. Profit before tax for first quarter 2021 is placed at negative rupees 1196 crores as against negative rupees 344 crores in the corresponding period last year. It may be noted that a major part of the loss is due to fixed expenses incurred during the period. That is, non-productive expenses for which no corresponding revenue has accrued to the company. Nearly 70% of the above loss is on account of such non-productive expenses, but for which the loss in Q1FY2021 would have been nearly at last year's level. Stringent budgetary control measures have been put in place to ensure that bare minimum expenses based on zero-based budgeting are incurred. Profit after tax for first quarter 2021 is placed at negative rupees 897 crores against negative rupees 216 crores during first quarter 1920. The company has been making strenuous efforts to bring focus on project completion and cash conservation, and these efforts are starting to show results. As a result of this, operating cash deficit has sharply reduced to 532 crores as against rupees 2,175 crores in the corresponding period last year. Cash collection as a percentage of net billing during the first quarter of FY 2021 has reached a peak of 133% compared to 114% achieved in the entire FY 1920. Receivables have reduced due to focus on project completion and timely billing. Total receivables at the end of Q1 FY 2021 are rupees 35,332 crores as compared to rupees 37,850 crores at the end of Q1 FY 1920. While the outlook continues to be tough, various initiatives taken in recent times, including the New Growth Areas Initiative, Make in India, collaborative manufacturing, improvement in operational and execution efficiencies through implementation of IT-based solutions for project monitoring, improvement in quality through Quality First initiative, HR initiatives, treasury operations for reducing finance costs, are expected to lay the foundation for a strong and growing BHEL for years to come. Thank you all once again for joining this conference call. We will take questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Mohit Kumar from City Research. Please go ahead.
Yeah. Good afternoon, sir. Good evening, sir. Two questions, sir. First, of course, it has been a tough quarter and the environment remains pretty bad. How do you see the execution in Q2 and the rest of the year? That's the first question. And secondly, sir, is it possible to give the breakup of the the receivables between contract assets and the trade receivables and corresponding number for inventory, cash, and payables?
As far as the execution is concerned, Q2 was there's a lot of improvement we are seeing happening in Q2, and we expect continuous improvement as the labor availability at the sites continues to go up. So by Q3 onwards, we expect a much better performance and normalization. So this is the state we are expecting. And as regards to the contract assets, I'll ask the finance to give you the details.
The total debtors as on 35,332 crores, out of which trade receivables are 11,836, which is down by almost 3,000 crore as compared to Q1 of last year. So the 11,836 crore Q1 is trade receivables, and the contract asset is 23,496. So total is 35,332 crores as far as total debtors are concerned. As CMD has already told, Q1 June 19 last year, the total debtors was 37,850. So down by almost 2,500 crore due to various initiatives taken by the company. Regarding inventory at the end of the quarter is 8649 net inventory, net of provisions. It is 8649 as compared to March ending of 8905.
It's a cash?
Cash balance is around 1168 crore.
1168 crore.
Q1. The deficit is 317 crore in Q1.
Mm-hmm. Understood, sir. So nice. One more question, if I may squeeze in, sir. Is it so you did touch upon the EOI you have signed with the three major MOU. Is it possible to give some commentary on when do you expect something material to take off, something which will add to our revenue, and or maybe something something which you believe is most likely can be done in next 1 year horizon?
So next 1 year is a marketing horizon that we are essentially looking at. But then besides this, you see there are a number of other shorter term sort of smaller efforts. These are the major ones, but there are a number of shorter ones which will fructify, but they'll be much smaller ones, much smaller volumes and sizes. But they will fructify in the current year. But these ones will take time to actually go through the complete the marketing phases and getting the orders and working on those.
Is there something in the PLI scheme which can help us?
Sorry?
Is there something in the production linked incentive scheme which we are looking forward to tap?
I don't think at the moment there is any, for these specific opportunities, I don't think there are any such incentives available at this point in time. But I think we will need to be actually working on those areas also to see what sort of thing can be incentives can be got.
Understood, sir. Thank you and best of luck, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Atul Tiwari from Citi. Please go ahead.
Yes, sir. Thanks a lot. So my question is again on these MOUs that you signed, the three of them. So what is the next step? Do these MOUs get converted into some kind of JVs or some kind of manufacturing order on you? And what is the quantum of investment that these partners have committed? And any idea on when we can see the revenues coming through from these MOUs?
I'll request Director Industries Systems to take that.
Yeah, I would like to respond on this. Basically, the MOUs what we are signing is with the industrial giants of this field, and this is a very preliminary MOU, and we will definitely be having more rounds of discussions and to address the opportunities. They are mainly pertain to defense as of now and transportation segment. Transportation, of course, can come a little early, but defense proposals will take some more time, and in some cases it may require some capex also, some investment in our existing factories. It all depends on how the negotiations and talks go forward, and how much of the technology transfer they are able to give. And we do have a lot of facilities available with us, so we will definitely try to minimize the effect, and to the extent possible, we will try to manufacture in-house.
Okay, so sir, but as of now, I mean, whatever discussions you have had with these partners, are these partners committing some investment also, or or the discussions on commitment of investment or transfer of technology are still going on and will fructify later?
Primarily, I think the discussions are around technology. There would be some in terms of, if they end up in JV formation, they would result in investments also. But the major focus, I think, will be on technology.
Okay. And sir, my last question is on this cash deficit. So fair to assume that this was probably funded by working capital borrowing. So would it be possible to share the gross debt on the balance sheet as on first quarter?
Gross debt on the balance sheet. Gross debtors. Debt on the balance sheet.
Yes, debt.
Achha, debt. You're talking of debt. Right now, there's not a material change in the gross debt. What we have reported as on March 20, but it is more than 5,000 crore as on date. The debt is more than 5,000 crore as on debt. But if you see the net cash bank balance after removing this gross debt, this is around 1168 crore as on date.
So 1168 is the cash or net cash?
Net cash. I'm talking of the net cash. It's 1168 crore. At the end of March, it was 1485 crore. So the deficit what has happened in quarter one is just 317 crore.
Okay. Okay, sir. Thank you.
Thank you. The next question is from the line of Sumit Kishore from JP Morgan. Please go ahead.
Good evening, sir. My first question is, what was the procurement from China in your raw material cost in the last fiscal, and how has shift away from China worked so far? What is the likely impact, as you look to shift your procurement away from that geography over the next 1 year, and given that most of the contracts are already midway as far as execution is concerned? That's my first question.
Can you just repeat the last bit of your question? I think the last one got a little...
Yes, so I was asking that what is the likely impact, if at all, for BHEL as you look to shift your procurement away from China, and what actually was being procured from China? What was the total, raw material cost which was sitting in China in the last financial year? You had spoken about this very briefly after the fourth quarter result also, that the supply chain disruption in China and Europe had impacted your numbers. But now, given the geopolitical situation, what is the likely impact?
So the overall imports from China in the last year was in the range of over 2,000 crores. Going forward, you see the major items that we are in our current basket, the major items where we are reliant on China is components for our FGD projects, as well as for the air-cooled condensers. And in addition to that, the solar modules for our solar power plant projects. So for the FGD, we have taken up a major initiative for development and manufacture of those items in-house, and we are looking at the same thing for the ACC. So what's happening is, you see, where orders have already been placed and work is in progress, that is continuing. However, where orders were yet to be placed, we are taking up the developmental work. For solar, we are shifting to our domestic manufacturers, domestic procurement of panels for solar power plants. That's how we are looking at going ahead with this.
Got it. So my second question is, while you mentioned that Lara, Singrauli, and Pench are likely to be in tendering, but what we hear from NTPC is that Lara and Singrauli are not up for award, at least in financial year FY21. And Pench, I am assuming, is the Adani Pench project. So what is likely to get awarded this year? Are we still waiting for that Odisha project of NTPC, and what is the status there?
Alcher we are looking forward to in the current year. So that we expect that to come through. The others, as you mentioned, will take time. Lara, Singrauli, Pench will certainly take time.
Fair enough. And, once again, it was Make in India 6 years back. It is Atmanirbhar Bharat now. Nothing has really changed. What BHL could have done 6 years back, it is talking about now. So Maglev, marine gas turbines, armored trucks, what is it that BHL is going to be doing, in all these things? And how much time frame are we looking at? Because, nothing is going to happen overnight. You're going to set up a manufacturing facility. So are we talking about, actual hard revenue coming in? And what is BHL's share? A foreign technology partner is not going to give margins on a platter to BHL.
That point is totally appreciated. Going forward, we will certainly, for example, when you look at the marine gas turbine, we will start off with the maintenance. We will start off looking at, the maintenance and services for the existing fleet, and thereafter go into taking up manufacture. And manufacture will always be phased and ultimately with an objective of the transfer of technology. As I mentioned, for the other areas, like FGDs, ACCs, all these, now we have actually taken up a huge initiative for in-house development and manufacture. In fact, if I may add, then even we are examining our entire basket of bought-out items and to review and see how much of that we can actually manufacture ourselves. So that process is also on, and which will show us the results over the period.
Sure. And just to clarify on the previous question, the cash amount was 1168 crore, but you were actually having a net debt because the debt was 5,000 crores. So there's no net cash in the company, there is a net debt.
No, that's the net cash. The number I told you, it was the net cash.
There are FDs, the total of
I'll give you the specific number. The gross cash and bank balance is 5795, and the borrowings against that is just 4896. No, not 4896. What is that number? Just a minute. Hold it. Yeah. Then this will come. Gross is this, and net borrowing is this, and net is this. Okay. The gross balance is 6064. Borrowings is 4896. The net balance is 1168.
Okay. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Ajinkya Bhatt from Macquarie. Please go ahead.
Hi, sir. Thanks for the opportunity. So just one question on the other expenses in this particular quarter, considering that this is significantly down in this quarter, can you tell us the numbers on what is the provision withdrawal, new provision creation, etc.?
Just one moment. We'll just give it a figure.
Yeah, thank you.
Creation, sir. You're asking for the creation as well. Okay. The creation in Q1 is 230 crore. Withdrawal is 192 crore. So the net is 38 crore. The net provision number is 38 crore. In Q1, the creation is 230 crores, while the withdrawal is 192 crore. As compared to Q1 of 1920, when the creation was 552 crore, withdrawal was 378 crore, and the net was 164 crore. So this time a benefit of 126 crore has happened as compared to the previous Q1 of 1920.
Okay, understood. Thank you so much.
Thank you.
That's it from us.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Yeah, thank you for the opportunity. First question is more of a data question. What is the executable order book on the total order book of 1,08,000? And if you could break this into power industry exports, and if you could also give detail of what is the FGD number in this.
The executable order book number as on 30th June is 87,967 crore. 87,967 crore is the executable order book. Non-executable order book is 20,159. So the total order book is 108,126 crore. Out of which the power sector is how much? It's 86,603. 13,447 is industry sector. 8,076 is international business.
And what is the FGD portion of the order book currently?
FGD must be around 5,000 crore.
14,000.
Actually, including everything here. Standalone and plus both.
And what is included in that?
Only?
14,500.
About 14,500 crores is FGD. Complete FGD.
Sure. The second question is, we were observing that the employee cost has actually jumped 24% sequentially as against the March quarter. If you could just explain this, would be useful.
But if you compare with the quarter one of last year, basically some adjustments, actuarial valuation gain has happened in the quarter four of last year. That's why that number appears to be lower on quarter four. But actually, if you compare with the quarter one of 1920, it is lower by almost 72 crores. So certainly some kind of valuation and actual gains and all those losses, generally we value it more accurately at the end of quarter four. So that's why the gap is visible. Otherwise, you see in totality, your personal payment there's a downward trend in personal payment. In 1819, it was 5,500 crore. In 1920, it was 5,400 crore. So the reduction is happening each and every quarter. The gap is basically because of actuarial gains which has happened in quarter four of 1920.
Sure. This last question from my side is, NTPC CMD in the analyst meet mentioned about focusing on renewables rather than thermal, and even the Honorable Minister of Power also spoke about that incrementally the capacity addition could be on the renewable space. So in light of this, where thermal is actually seeing disruption, if you could highlight what are the measures that we are taking on the cost side, considering that we have a 20 gigawatt capacity and now utilizing that seems to be distant. So it will be useful to understand on the cost side the structural measures that we are taking.
First, I would like to answer. I think rest of the question can be answered. First, I would like to talk on the capacity of 20 gigawatt. What we talk about, or 20,000 megawatt. We are reworking out our, reviewing our capacities in terms of the manpower. Also, is retiring. 2,000 people are retiring every year. So that is also one part. We are looking at how what is the real capacities of BHL that we have taken this to the board also. So that is one part. It's not that substantial reduction will be there, but some reduction certainly will happen on those capacities, what we have declared earlier. That's the point. Now, second can
So let me add a little to that. So you see, there is no doubt that this is a steady decline we see in the power sector market. But the CEA's own forecasts are talking of 80 to 90,000 megawatt over the next 10 years. So we are looking that sounds to about 8 to 9,000 megawatts per annum on an average, which will also be matched with the the requirements that we will, when we are talking of a $5 trillion economy. The power requirements will actually continue to go up, even though we are seeing a short-term downtrend which is there at this point in time. So over a long-term basis, that requirement will be there, and it will have, and the base loads will have to be met by thermal till batteries come to match the thermal costs, which seems to be some time away even as yet. The second point is that you see to deal with this downtrend, we are looking at two aspects actually. One, diversification away into the various areas that we talked about. We talked about EPC for oil and gas. We're talking of expansion in the railways and defense and at the same time in the power sector itself, we are looking at higher efficiency power plants. We are looking at Industry 4.0 solutions for maintenance of existing power plants. So then we are looking at emission control equipment, the various, the areas within the thermal sector which will continue to have requirements for times to come. And then coming back to the capacities, you see, but what I mentioned about the Make in India group and these various efforts which are going on, they are actually targeted at utilization of those capacities through alternative, so we are trying to generate alternative business for those capacity that we already had, which may also, of course, include certain other, investment that we may need to make, balancing investment, other types of investments, reskilling and things like that. But ultimately, we are looking to fill up our basket with all these areas.
Sure. Yeah, thank you so much.
Yeah, sure.
Thank you so much.
Thank you.
Thank you. The next question is from Ranjit Sivaram from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Just wanted to with you regarding this receivables. You give the breakup in terms of SCB, PSU, and private. Can you share that? How is that?
Can you repeat that, please, Sivaram?
The receivables, you generally give the breakup between SCB, PSU, private and export. So how is that?
Yeah. 48% of the total receivables as of 30th June is 36,829, of which 48% state, 33% central, 12 private customers and 7% exports.
Okay. And sir, how much is that collectibles and other?
The collectible, 11,836 crore is collectible, and the rest of things is others.
Okay. And the retention amount in that?
Retention amount is almost 15,400 crore.
Okay, so compared to Q4, retention has come down a bit.
Yeah.
Okay. And sir, there has been some news articles mentioning regarding some partnership with the Rheinmetall. So just wanted to check with you, is there any talks or some strategic plans towards that?
Partnership with what name did you say?
Rheinmetall, German company.
Rheinmetall.
Rheinmetall, yeah.
So there are some discussions still on. You see, this is one of the areas we are discussing under our EOI. They are all very preliminary stage. These are not things to be actually talked about at this point till they come to some sort of some form basis.
Okay, and sir, lastly, this there is a lot of opportunity when you look at the commercial airspace, and companies like Airbus, Boeing, and those multinationals are looking at a partner in private-public partner in India. So in that context, are we also actively looking at, because this can be a potential large opportunity for us also, given the kind of demand this airline traveling will have in the country. So are we also looking at that space?
So aerospace segment we are looking at. I wouldn't yet like to get into very specifics, but yes, there are various options we are exploring in that area. But very preliminary stages yet.
Okay, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Dhruv Muchal from HDFC Mutual Fund. Please go ahead.
Yeah, thank you. So when you mentioned retention amount of 15,400, what does this mean? Does it mean that the projects are completed and you have retained this amount and it will be given probably after a year or so, the typical contractual terms?
No, the projects are yet to be completed. These are the amounts. Once the milestone and trial operation and performance guarantee tests are over, only these amounts will become due. But we have already considered the revenue for these also as per the accounting standards. So this is not actually due for payment. That's why we call them as contract assets unbilled revenue. So this will become due only when these related milestones are over. So this much of amount, if you see the trend of the company in the last 10 years, almost 15,600 crore of money is always lying under retention. So this is a permanent, it's sometimes some amount gets liquidated, some gets added. So ultimately this always remains in the same range. So there's nothing to worry on this front. This money will come suddenly once the milestones are completed.
Right. No, so typically what we think of as retention is that once a project is complete, there is a 5% kind of retention for guarantees and all those things. I mean, typically it happens that after 1 year you get that payment. This is not that kind of amount. This is something else.
It is not that kind of amount. It is not that kind of amount. It is this retention because you are using, we call this particular retention, for our terminology is deferred payment or a milestone related payment, but there's no retention like that, that basically these are the amount, when the trial operation and the performance guarantee test are done. Mm-hmm. So there's nothing like that retention, that will be released after 1 year or everything is over. Nothing like that. We don't have a retention in our payment term.
Got it. So coming to the China dependence. Now, in one of the earlier questions, you mentioned that we depend for about 2,000 odd crores in terms of raw material cost. But sir, in our 4Q numbers, we had a significant impact, as you had mentioned earlier. That was because of the supply chain issue, and I understand that was largely because of China. So, sir, how do I reconcile this? I mean, 2,000 crores seems a very small number on your total on your total raw material cost. So, what's the gap here, sir?
Let me put it this way: if there is a 10, 15, or 15 crore locomotive to go out, and there is a 1 lakh rupee component which is to come from China, that 15 crore is stuck.
Okay, that is. So got it. Understood, sir. Okay. And sir, in terms of the progress on site, is it possible to share, in terms of probably some numerical way that probably what is the labor availability at most of our sites where you're executing projects? If you track it on that basis, just to understand what is the level of operations and how fast are we ramping up. So probably by the end of August, what was the number? The labor availability was 50% or 70%, something of that.
No, the labor at the sites was around 60% plus by end of August, which during the pre-COVID times had run down to 16%. So that way the revamping has been done, and most of the NTPC projects it's ranging around 90% plus out of China. And by October end of November mid, we are hoping that we will be back to square one by 100% what we had before COVID. What projects are on it?
Got it. And so last question, if I may, is probably a very, I'm not very sure that if you share this kind of data, is now we have the order book that we have are largely power assets. Now power assets have a steady execution phase. I mean, you also are largely understood in terms of when this project has to be commissioned, in terms of timelines, you would be knowing that. So is it possible to share the order book's time scaling? I mean, by when, say for example, in 1 year it will be 20% consumed by the current order book. By first year it will be end of first year it will be 20% consumed. By the end of second year it will be 40%. So some kind of scaling, is it possible to understand? Because that will help us understand how does this order book move over the next, say, 3-4 years.
Well, typically you can look at a 3-year span for the entire order book. I mean, and it's more or less balanced, maybe a little bit, 10-15% up or down. But because it's a mix.
Okay. So because
let me just add, the China figure actually 2000 was a different figure. China is 1,000 crores is the last year's figure. 2000 actually was a different figure in terms of what our current outstanding orders. But last year figure was 1,000 crores.
Mm-hmm. So just coming to the earlier question, you mentioned 3 years of execution. Now I'm just wondering, based on 3 years of execution, the annual execution comes to about 40,000 crores. So is that a fair number to assume in terms of the execution for the next, say, annually for the next 2-3 years? Because that number then does not reconcile with what you have been doing for the last 2-3 years. So that was the worry. I mean, that was the question actually.
So actually, for you will need to look at the executable order book first. And then when you're looking at a gross figure, you will have to look at a net figure, net of the GST.
Oh, okay. So the order book number
will come to a figure which matches with what we are talking about.
Okay. So this order book number includes the GST amount also.
The gross number includes the GST.
Okay. Okay. The executed gross order book number will include GST. Okay. So I reduce about 15% from this number, 15 to 12%, and then calculate the
76 crore is excluding GST.
Is excluding GST and it is excluding the executable. Actually, the executable excluding GST is in that range.
76 you mentioned, sir?
Yeah, 75. It's about the range of 75,000.
75,000. So this I could assume over a 3 to 4 year period. It can be.
Well, yeah, about that. That's about it. Yes.
Got it, sir. And so just one last thing. If I break up the receivables, the total receivables including contractual assets into non-current and current as you report. So the non-current portion is about 60% of the total amount. So that means they are due after 1 year. So, I'm just trying to understand, these receivables are not due yet. They will be due once the project execution happens, the milestone is reached, the contractual assets get converted to a receivable amount, and then you receive it, right? Because a large portion of that is in the non-current portion.
Yeah, true. That is true. This is mainly because of the payment terms, the kind of payment terms we got in the recent orders in recent past, It is because of that, this non-current portion is now becoming heavier. And that is also one of the major reasons for the company going into cash deficit. It is not that because of the internal inefficiencies of the company is in cash deficit, but it is because of now the customer you must know the payment terms of Patra 2. Even I take the order of NTPC Patra 2, where the advance is 5% and 30% is against dispatches, and rest of 50% payment comes against the completion of all related milestones. So now the expectation, and these are the types of order which are available in the market. And the expectations, even the customer is expecting indirectly to BHEL that we must fund their project. So that is the reason, why the company is into cash deficit. Ultimately, now these are the only orders and these are all zero deviation tenders. We cannot take any deviation also. So these, whatever best orders are there in the market, we are trying to work out best. And we are still, we are indirectly funding these projects, That's why the non-current portion is going up. Otherwise, it is not that because of the inefficiency or other reasons, the cash deficit is there. It is because we are funding. Had we not been funding these orders and working as we were working before pre-GST regime, basically, if you look at the company's cash deficit and the current, the non-current going up, there are two reasons mainly. One, the GST outflow after pre-GST has increased. The pre-GST tax rate was 9%, average tax rate. Now it has gone to 17%, almost doubled. So outflow has happened from company side, but my money got blocked into contract assets and the debtors. So that is one part. And second, the payment terms. So the payment terms have also made the things difficult. But ultimately, this is cycle. Because in long run, this is going to improve. Probably the improvement should happen in the next year, from next year onward, on the cash front.
Got it. So basically the movement will be like this. Non-current contractual assets will move to current contractual assets and then they will move to the trade receivables. Current trade receivables.
Yeah.
Okay, got it. And so just one last question is on the trade receivables, the non-current portion. In your annual report, you mentioned that amount is about 5,700 crores. You mentioned that is relating
non-current.
Non-current, yeah. So you mentioned there are some settlement dues also. I'm just reading the statement where you mentioned there are some settlement dues or contractual dues which are yet to be settled, and based on those settlements, that amount will be, decided. So are there any, I'm just wondering, is it
sector money, the certain projects are on hold, certain are legal, certain are legal issues. So once that legal and arbitration issues are over, and mostly that should be in favor of the company. That's why we have put those debtors of 5,000 crore into non-current category. Because once the issue is under litigation or arbitration, it is difficult to say whether it's a current or non-current. So by the time, suppose if it gets settled earlier also, the money can come this year also. But while making the books, what we have done, we have taken it more conservatively and put it into non-current category.
Got it. So of the 5,700 crores, how much will be private?
Private, approximately right now, I don't have number. I will tell my corporate finance. You can take the number later on, from this. The number. I don't have the breakup right now of the 5270. What is the private? But private should be around maybe 20-25% should be private.
Okay. And the rest would be, say, central and state government, but the amount there is disputed or something. There are some settlements which have yet to be done. right?
Yeah.
Okay. Otherwise, our trade receivable for you will always be current, unless it is some dispute.
Yeah.
Or the project is stuck.
Yes.
Got it. That is very clear, sir. Thank you so much, sir.
Thank you.
Thank you. The next question is from Renu Baid from IIFL Capital. Please go ahead.
Yeah. Hi, good evening, sir. Probably I joined a bit late, so please excuse me in case if I repeat the question. So my first question is, can you help us provide some update on the technology transfer agreement that we have with erstwhile Alstom and GE now? I guess that's expiring in October 2020. So where are the discussions? Are we looking for an extension with expanded scope for technologies, or you think the journey with GE was so far until your own day?
Discussions are on. We have still to work out, looking at our overall portfolio, how we are going to take it forward. Those discussions have been on. So not yet finalized.
Right. But in your view, it should be finalized by October, because otherwise for a lot of contracts or projects, there is a bit of discontinuity in terms of the agreement or the...
No, we'll ensure that there is no discontinuity, that we are conscious of that, so we'll ensure that.
Right. I think my question was more specific because in the last couple of quarters, we have heard from them that there have been a lot of delays of payments, not only for some of the supplies, which we have been doing in terms of commercial agreements, but also for the royalty payments. There have been delays to GE, for which they had temporarily suspended few project activities as well. So has business now been back to normal with them, or still there have been a bit of hiccups or issues in terms of payments or discrepancies?
I think there
have been issues from both sides, but I think that is being mostly settled.
Okay, sure. And so secondly, if I recollect, in the last 6 to 12 months, we have been very aggressively chasing retentions and pending payments from some of the private sector players, stuck projects as well as players in money stuck. We were expecting some cash receipts as well. So can you throw some light in terms of what is the status of cash collections from some of these private sector players and IPPs? The money was stuck, and have we been able to reduce the receivables or collections from them?
You are asking for the quarter one, the number right now, I don't have that number, how much has come actually from those contracts. Yeah, this number, I will ask Yogesh to give you. You take from Yogesh. We'll give you this number.
Sure. And so my last question is, we mentioned about a lot of initiatives that we've been speaking about on Make in India side and diversification. Would you, as in your perspective, over the next 12-18 months, do you perceive any of these initiatives to actually materialize and crystallize in terms of commercial business for us? Or in your view, some of these decisions could still be a little more long stretched in terms of converting to commercial business activities?
So as I said earlier, you see, what's happening is there will be small bits and pieces which are already materializing, but those are very too small to talk about. But the very big ones will certainly take time, and there will be some in between, so it will be a complete sort of continuum. But there are a number of issues, things in the basket, so that mix will go ahead.
Okay. As in, would you can you share, as in which particular segments could be among the early segments in the basket which could commercialize, and which segments from a business perspective could be slightly more long drawn? Say, probably defense could be a bit more long drawn, or new ventures. So as in, would there be certain examples or more details that you would have at this time, or still?
So you see, what would happen quickly is things like contract manufacturing, which could be for various segments. Things where we are using our capacities for contract manufacturing for various people. Those would come very quickly. Then we have already started sort of going out and bidding in oil and gas, EPC oil and gas. We are already in the process of bidding, so which is a part of the NGA, not the UI, but then and we have made some bids for the railways. So that process is of course, defense is a different story, but these two are already happening.
Sure.
But then again, when it converts to an order, and then when the order converts to a turnover, that of course will certainly take time.
So probably contract manufacturing could come a bit more earlier, maybe by the end of this financial year or early next year, but the other initiatives could take a bit more time.
So as I said, small bits in that have already started, but by the end of the year, we'll certainly have much more sizable sort of numbers.
Right.
In that area.
And I think there were some media speculations also. The government wants India to start backward manufacturing in terms of solar PV cells and the wafers and components there. So BHEL's name was thrown up across a lot of media articles. So would you want to share any of your initiatives where BHEL could take a lead in terms of being one of the component suppliers for Make in India in the solar panel components, which would be your wafers and other materials getting in there?
We are looking at a number of options. Of course, something like, for example, inverters, PCUs, we are already looking at, that we'll come into that very quickly. But the larger sort of thing that you're talking about, that is going to take time. We are still evaluating because viabilities are an issue. We are trying to, work on that. That's the major area to work on.
Right.
Investments are huge, viabilities are an issue, so that will take
time. Right. And lastly,
I'm sorry to interrupt, but maybe request you to rejoin the queue as there are several participants waiting their turn.
Sure, no problem. Thank you.
Thank you.
Thank you.
We take the next question from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you for taking my question. Sir, in continuation with one of the previous participants, I mean, even if some of these MOUs go through, eventually what we'll be doing will be contract manufacturing for them. Is there a plan of technology transfer from any of those eventually? And if not, then can you just highlight that to move away from being just a power equipment manufacturer, any specific R&D expenditure or anything else that we are doing? I mean, my question is more from a medium-term perspective. What is the company doing for internal skill building so that our move away from power equipment, could actually garner us a bigger market share of the industrial piece? Could you just talk about how we look at the next few years in terms of both technology transfer and in terms of internal R&D ability?
So there are two, three different things actually. You see, contract manufacturing we are talking about, that's a totally separate thing, which I said, there are smaller opportunities. They're different. This is a different basket. We have a large number we have almost 70 responses against the US example. And maybe half of them will fall into the range of, the smaller responses will fall into the range of, contract manufacturing and that sort of stuff, which we are already moving on, but they are very small numbers, quantities, the sizes. So the really big ones are when we talked of the MOU, and there we are in the bigger ones we are looking at technology transfer in all of them. So which will happen in phases, obviously. So that will take much more time. And the other thing that we are, as I already mentioned, is that we are looking at in-house development for the entire range of items we are today buying out. So in that we are evaluating what are the items which we can actually manufacture ourselves. So that is a major effort which we've already taken up.
So if that is the case, then could you also guide what could be our capex for the next 2 to 3 years? Because I assume for manufacturing some of those items which today you are buying out, we will need to incur some additional capital expenditure. Is that right?
That's right. So they are coming in different bits and pieces, and I think maybe by the end of the, maybe in the next few months we'll get a better handle on the numbers. So for each item there is some capex involved. Some cases, of course, there is very little, but others there are. But there are a number of them, so they are yet to be collated together.
Sure, I'll take it offline. Thank you, sir.
Thank you. The next question is from the line of Bhavin Vithlani from SBI Mutual Fund. Please go ahead.
Okay, thank you for the opportunity again. In the annual report, you had mentioned that there is a significant focus on spares and services as a business segment. So if you could just highlight a bit more on this. The order inflow was about 3,100 crores. But if you could highlight what was it as a part of the revenue, and if the total BHEL fleet, what is our wallet share is like? If the plants are 100, what is the spare that we are actually servicing? What's the spare that customer is buying from outside agencies? So how much can we scale this 3,100 crores order flow up to?
So at the moment, the revenue is in the range of about 11 or 12%. But going forward, you see, we are looking at a couple of specific initiatives. One, as I said, Industry 4.0 solutions for the power industry. So that is an entirely new sort of a area that we are building up. Second, we are looking at providing spares and services for non-OEMs. There's a lot of non-OEM plants where they are being left high and dry in the current situation. So that's a major initiative that we have taken up. And of course, we are strengthening our own offering to where we have been providing spares. We are strengthening that offering also.
So, how large can this revenue potential be over the next 3 years, if one were to?
I don't think I would like to engage in that crystal ball gazing at the moment, but yes, we expect it to multiply as a percentage.
Okay, sure. Just last question from my side. This was discussed in the previous quarter's earnings call, where you had mentioned about retention money or the money which is due where plants are completed but PG test is pending, and there is a serious effort which is being underway to actually liquidate this where the plants are already being completed. So if you could highlight what's that number in terms of receivables where PG test is pending but the plants are completed. And a connected question is, we have been seeing a 4,000 crore as roughly 4,000 crores of receivables from the private sector for now many years. So if you could just highlight the ECL policy on this.
PG tests, so you see the total in terms of value is about 1,400 to 1,500 crores is the sort of figure that we are looking at, and we have planned out how within the year or so how the maximum what we can do, so that the specific target laid on what activities. There are some plants, of course, where there are issues, major interventions required. That will take longer, but the other ones will largely get done in the current year. Sorry, what was the second question?
Say 4,000 roughly 4,000 odd crore is the receivables from the private sector, which has been there for a few years now. And just wanted to highlight, just wanted to get your thought process on this. What are these receivables and our ECL policy on the receivables?
Private sector is talking about private sector that wherever collection is required, they are not yet already on the payroll. Yes.
So private sector, you see, a lot of them have now gone into the legal route. So that will take its due course. Where we could do some settlements have been made in the recent past, but where that was not happening, we have taken up the legal route.
As far as ECL provisioning is concerned on the private customer, that is being taken care of in provisioning. So even that private sector money is also being considered ECL. But we are not providing that money unless that arbitration legal route is over. So that's the policy of the company, that we don't provide unless, we have a clarity that where you're going to get the money or not. So arbitration, most of the private customers are under arbitration right now, what CMD has told you. So, but as far as ECL provisioning is concerned, certainly it is being done every year.
Sure. Yeah. Thank you so much for taking my questions.
Thank you.
Thank you. The next question is from the line of Abhishek Puri from Axis Capital. Please go ahead.
For the opportunity. Sir, on the cost control, which somebody asked earlier, can you please, elaborate few things which you're doing apart from 2,000 people that are retiring that you mentioned? Given that, we have 8,500 crore cash, fixed costs, and 25,000 crore turnover is required to, even break even here. So, and second question is in terms of FGD business, our gross margins have been reduced from 40% to almost 34% in the last 2-3 quarters since we have started doing FGD. So how are the margins in that business, and is there any reason, apart from FGD that has led to this decline in margins?
So as far as the cost reduction front is concerned, you see that is a challenge taken on multiple fronts. The biggest cost for us is the material cost, which is amounting to in the previous 6%. And there we have taken on initiatives in terms of design as well as in terms of procurement costs. Of course those initiatives will take time to bear fruit. As far as other costs on the other hand, look at the Abhishek. Sir, if you look at the other expense, Abhishek, you see even the quarter one is just 360 crore, and last quarter one 1920 it was 740, 907 in quarter four of 1920. If you compare any of the numbers, this is the lowest number of other expenses in any of the quarters in the last 10 years. So this is the lowest level of other expenses, and means you see other expenses of I can give you the breakup also if you want. Every provisions are also down, power fuel consumption, indirect material, other expenses of manufacturing, selling, each and every line item is down, So the stringent budgetary control measures have been put in place. That is also affecting, and COVID is also one of the reasons. I know that other expenses have gone down because the top line has gone down. So basically now we have most of the expenses we have just basically correlated with the top line. If the top line is there, then only these expenses will be allowed to be incurred. So there are two reasons, but certainly efforts are being made on middle line. And even last year, if you see 1920 also, we could restrict our loss to the level of 662 crore. That has happened because of the control on other expenses. So other expenses is being targeted very seriously. Secondly, there are certain challenges in this, metal cost. Yes, FGD is a competitive business. The margins which you can expect from the normal thermal business cannot be from FGD business. It's a competitive thing, for everyone, not for BHEL. So still we're working it out, how much best we can earn from FGD also. And again, FGD, there is a specific effort on for cost reduction through whether, in-house production and redesign, in-house production. A specific effort has been put in for the FGD projects because there we are seeing very tight situation there. So we are making that specific effort there.
Also helpful, sir. Secondly, in terms of the spares business, this has been a focus area as per your annual report and various comments earlier. So why are FY20 orders lower than FY19? I mean, this is about 3,089 crores, if I'm not mistaken. And what can lead to an increase in this business? As we've heard from Ministry of Power also, they are looking to shut old projects of 30 to 40 gigawatts. Can this business really grow for us, in a meaningful way is what I'm trying to understand.
Current year, we are going good, so we are already tied up with that. 1920 is asking the 1920 order book is lower by almost 3,000 crore. Last quarter was issue. Last quarter was issue because of COVID is still not.
The 3,900 crore was reduced to almost 3,089 odd crores. So almost 700-800 crores reduction in SSBG order inflows. And this is a very high margin business.
Power to take.
Sure, sir.
Okay, he's not able to. So actually what the question is, I think, Abhishek, if I'm correctly telling you, this 18-19, it was 3,800 crore space order. It has come down to 3,100 crore. You're talking about that?
That's right, sir.
So it has gone down here. But it's not if you see, even in that years also, in 14, 15, 15, 16, 16, 17, 17, 18, this level used to be always 2,500 crore, 2,400 crore. So even that number, even if it is lower than 18, 19, still, it is much better than the number of, much earlier years. So it is almost, at least it has crossed 3,000 crore. But because of some reasons, some orders were to be finalized in quarter four of last year that could not be concluded. I think that's the reason. And एक RNM का depends करता है completion of orders. वो last year वाला RNM का order था ना 18. वो भी होगा. That may be also a concern. But you see, on that front, I've already mentioned some of the initiatives that are being taken because that is something we have to look at in a major way going ahead. And I've already mentioned about the initiative in terms of, the spares for the non-OEM spares, as well as specific efforts to improve our offering to the OEMs also. Because some of our OEMs are also going in for, procurement from from other sources. So there also we are making efforts to see how we can get that business. And of course, services along with the spares. I already mentioned, the other areas they're looking at.
Right, sir. Thank you so much and all the very best.
Thank you.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Thank you, ladies and gentlemen, for your patient hearing and an interactive question-answer session. Thank you very much for your interest in BHEL. Goodbye.